So welcome back to Fluoro Finance Chats. My next guest is Vincent, or as I've named him incorrectly for many years, Vincenzo. He's an authorized representative of RM Capital and has worked in the financial service industry for 22 years and has been a licensed financial advisor for 18 years. Vince has a Bachelor of Business with a double major in accounting and finance, a graduate diploma in financial planning, and a Master's of Applied Finance. Apart from spending time with family and friends, his main passions are sport, travel, watching a good TV series, and investing. So, Vince, it's good to have you on the show.
Hi, Janine. Thanks for having me.
It's good to have you. Obviously, this is a new show that I've started, and the reason why I've pulled you on, number one, you don't want your face on social media, but I want you to be on social media because, you're my financial advisor. I've also given you clients that I've trusted with you because you've got such a wealth of experience and you've seen different market cycles. You're not too young where you don't understand the different market cycles. You've watched the boom and busts throughout time. And I think that your education just speaks for itself. I think that the way that you work with clients is very relationship based. And I really like that about you. I've known you for about 7 years now as well, which is crazy.
Right, yeah.
It's actually gone past.
Time flies.
Yeah. But I think that it's vital that we bring you to the show because a lot of mortgage brokers, they operate as that transactional, which is that they're just there to bring a client in, they want a home loan, move on. Because I educated myself, so Bachelor of Commerce, I've got a diploma in financial planning and diploma in mortgage broking. When I'm looking at my clients, I'm looking at them more holistically. So for me, having that education and the experience with working in this sector for over a decade, I've seen everybody's financial position is unique, right? But when you see a lot of repetitive stuff, you can also pick pitfalls. When it's important for me to engage you is when I'm seeing superannuation issues or lack of insurance issues. And people, obviously, there's a lot of people that don't get financial advice that really do need.
Yeah, absolutely. Yeah.
And I'm fortunate that I can capture them early on because generally people are only thinking about loans. There's income and loans and the rest just kind of happens in the back end. Yeah. What's important is that you capture people at vital stages of their life. So what I want you to talk about is what you actually do as a financial advisor.
Yeah, well, probably the main thing as a financial advisor is to help clients get to a stage of financial utopia, really.
Yeah.
So you meet with clients, the process is basically you gather as much information as possible. So obviously most of their financial situation and and then you find out what their goals and objectives are. And ideally you're trying to get those clients to meet those goals and objectives. So the process is you meet with the clients again, you gather as much information as you can because to make, the appropriate recommendations and strategies, you need as much information as you can.
Yeah.
And then you go away and you devise strategies to help those clients get to those objectives.
Yep.
And then you present it to the client and hopefully, they want to proceed. You implement the strategies. Yeah. And then it's about reviewing it and making sure that those strategies are going to be met. At the end of the day, there's only so much you can do as an advisor. You can't twist anybody's arm. It's ultimately their sacrifice and decision to implement the strategies that are going to get them to that position. Then it's a matter of reviewing them and constantly catching up with them to see if their strategies have changed or their circumstances have changed. And if that's the case, well, then you tweak or you change the strategy. But yeah, ideally, everyone wants financial freedom. And that's the role of a financial planner is to help them reach that financial freedom stage.
So what I guess it comes down to is it's a financial literacy piece, right? Because if you don't know, you don't know.
Correct.
So I think that's the conduit between myself and you is I know what they don't know.
Yeah.
And I'm seeing a pitfall and thinking, okay, I can't advise on it because I'm not on the register at the moment. But ultimately, I can pass these clients on to you because I'll say, I'm seeing pitfalls in XYZ. Obviously, I'm not advising, but I'm saying, have you considered actually maybe you should speak to somebody?
Absolutely.
So I'd say basics as such as somebody's got 4 superannuation funds and it's like, have you thought about talking to an advisor?
Yeah.
And then you're like, oh, well, actually, they just moved from industry to industry or they moved from employer to another employer and then each of them have got a superannuation fund.
Yeah.
and they don't think to consolidate, and they don't understand the pros and cons of having so many superannuation funds.
Yeah.
I guess that's just a basic idea why somebody should come to an advisor. Yeah. So when I'm looking at these clients that are coming to me and they've got these minor issues that I think that are worth at least having a conversation with, ultimately my role is not to be involved. It's just that they may or may not need your services. At least they have somebody independent that can have a look at it and say yes or no.
Absolutely.
Your job is not sales. You're relationship based. You're building a client base that are going to stick with you for the long haul, right? It's not about jumping in and jumping out, because people have got so many, you're going through stages of life. So you're young and you've got no family. Then all of a sudden you're in a relationship. Then you've got a child coming along, you're getting married.
Yeah.
Might be a divorce, hopefully not.
Yeah.
And people are going through stages, and each one of those stages has different needs.
Correct.
And adjustments, right? So sometimes the income's going to be increasing, then sometimes it's pulling back, especially for women coming in and out of the workforce. So I think that a financial advisor is extremely important, especially if you don't have basic fundamentals.
100%.
That's my feedback on it.
Yes, absolutely. Yeah. And I, obviously I'm going to agree with you, preaching to the converted there, but absolutely, like it's, people think they're on the right track, and they don't really give it too much consideration. When you're young, you got other priorities, like you said, a young family, you got a mortgage, you sending your kids to school, there's a private school, they're playing 4 or 5 different sports. That all costs money, but the sacrifice there, or what you're missing out on by concentrating all that, is your financial goals and objectives. A big one's insurance, which we'll probably touch on later on. But, clients with their insurances not taking what level of cover they have, and, if something were to happen to them, illness or injury, how that puts them off track and how that will impact their family. People ignore it. It might be the costs or just the time.
Think it's fallible.
Sorry, exactly right. And everyone does, right? So, so 100% that, obviously the role of a financial planner is to just make people aware of what's out there, the strategies that they can implement, how it will help them achieve their goals and objectives. And again, it's ultimately up to them.
I find what I find interesting is that you can be high net worth and still need an advisor.
Oh, absolutely. The amount of people out there, that earn really, really good money, you'll be the top 5% of income earners, and you sit down and you obtain their assets and liabilities and their financial position. You think, wow, like they should be in a much better position than they are. Obviously, people like to spend their money, keep up with their neighbours and their friends that are in the similar position. And you find that they're not going to meet their goals and objectives. So that is a classic example.
I think it's a complacency as well, because obviously if you've got a great net income coming in and you're like, well, I'm doing okay, I'm doing fantastic, but you could be doing much better.
100%, exactly right.
I think there's always room for improvement. Yeah. Some people have absolutely nailed it, but they already know what they're doing. Yeah. Right? They're affluent, but they've got the experience, they've got the education, they're successful in many ways.
Correct.
And they've probably invested in all sorts of assets.
Yeah.
What I've found during my time as a broker, obviously because I get to see assets and liabilities all the time on a day-to-day basis, you'll see people very heavily geared in one aspect. So they might just be very property driven.
Yeah.
Then you'll get somebody that's very stock driven and doesn't like a property.
Correct.
And I've never really seen a perfect blend of both. And that's something that I found very interesting in my career, is that people, if they get burned once in one asset class, they won't want to put in on the other one. And I'm sure you know this, so in your job, because I know, and correct me if I'm wrong, many people, when it comes to stocks, they're so like, it's just something they can't really think about. And there's just so much they can do, like they can do really well with it.
Yeah.
Like even just a small amount of money can go a long way. Right?
Yeah, absolutely.
Let's say your net income.
Correct.
So for example, you're bringing in, combined with your partner, $8,000 net income, and then your living expenses are only $3,500 a month, including like a mortgage or rent or whatever. You've got all this dispensable cash. The problem that I see from a loans perspective is people then use that cash to then go and buy a nice car, go buy a jet ski, go and buy all these stupid toys that appreciate in value, where your job is to come in and say, well, hey, with that net income, why don't you go and put some of this?
Exactly right. Exactly right. And and the classic example there, when you're talking about they have a bad experience and then they want to, avoid it, is superannuation. Yeah. The amount of people you talk to and you go, you should be putting more money into superannuation. And I know someone that lost all this money during the GFC in their superannuation, so they want to steer clear away from superannuation. And superannuation is a great vehicle to accumulate wealth because of the tax benefits. So, I get clients and family members as an example where and they're nearing retirement, and you say to them, well, you need to start putting more money into superannuation. You can put money into superannuation and leave it in cash in a bank account, but you might get this real upfront tax benefit from doing so. So it's a classic example where people do hear stories and then they don't want to go and, get involved in a certain asset class or a certain strategy. Yeah, and it's up to us to ultimately try and educate clients on that.
Because I guess, look, mortgage brokers are so leaning towards property because that's what they do. They earn their money by getting that. But sometimes, and I've seen it with my clients where if they want to invest in property, that might not even be actually ideal for them. They need to understand that there's alternatives out there, and to get information from the likes of yourself that's experienced with 20 years experience in what you're doing with the education, to be able to say, well, have you considered X, Y, and Z? And then what's going to work best for you?
Correct.
It might not just be jump on the property ladder because everybody else is doing it and they all want to have a property portfolio because it's the Australian dream. Yeah. Sometimes comparing X with Y, this is actually the better option. So for me, it's important that when I'm speaking with my clients, I'm seeing what they're actually trying to tell me, because I can read between the lines and then think, well, maybe they should be talking to somebody else. Maybe it's not me that they need. Yeah. Because it's not about transactions for me. It's about what's actually in the best interest. Yeah. Sometimes it might not be the debt. Yeah. It might be that, hey, we need to go and speak to Vince, or go speak to some other financial advisor, or speak to somebody in some other asset class or whatever it may be. Correct. But I think that I'm blessed in that I get to have the information up front, and that can reveal a lot about his client.
Yeah, exactly right.
So, for example, we recently had some clients that reached out to me direct and said, look, my husband's retiring. He's also just got a redundancy. What's my next steps? Obviously, I can't advise on that, but I said, and then they've asked me specifically if I know of any people, and I've given them 3 names, and then they've come to yourself. Yeah. And what was it that you found? So what did you end up doing with these clients? Yeah,
so basically these clients, the husband was about to be made redundant, getting a nice lump sum payment via his redundancy, and the intention of retiring. So nice superannuation balance. They came to speak to me predominantly regarding their superannuation, what to do with that, and also that redundancy payment, how to spend that redundancy payment. So basically came in and obviously had a look at their superannuation. But again, this would be the classic example where these clients, like most people, don't know all the different strategies out there. Yep. So one strategy that I did implement with the clients as part of the overall superannuation, review. Yep. Plus how to spend their redundancy, is a strategy called recontribution strategy. So basically what that strategy is a strategy where ultimately you're trying to reduce the tax paid by beneficiaries who receive a superannuation death payment. So someone passes away, they got a whole lump of superannuation. You should have a beneficiary appointed on your superannuation. Most people appoint their spouses or their estate, so it goes according to their will. So basically, again, this is a strategy that tries to reduce the tax paid by certain beneficiaries if they receive that death payment. And when you look at your superannuation, there's different components. So again, most people won't know this. So if you look at your latest statement or you log into your superannuation account, you can see the account details and there'll be different components. Now, there's a few components, but the main ones are what's called tax-free and taxable. Yeah. So, and most people would have taxable. So their component will be mostly made up of taxable. And what taxable is concessional contributions. So
can you expand on that? Because
absolutely. Yes.
The difference between concessional and non-concessional.
Absolutely. So I'll talk about that now. So concessional is made up of, if you're employed, the employer pays the compulsory superannuation. Yeah. And that at the moment is 11.5% of your income. So you earn $100,000, your employer has to put $11,500 into your superannuation. That is going to go up to 12% next financial year on the 1st. Yeah, exactly right, the 1st of July. So that's one form of concessional contribution. Now, let's say people salary sacrifice into super to reduce their income, reduce the amount of tax they pay. That's another form of concessional. Or if you're self-employed and you want to make a contribution into super to reduce your taxable income and tax payable, they're all concessional contributions.
One of the bonuses is, bonuses, but it depends on what the position is for that client. Is if they're self-employed, they don't generally have to contribute.
Correct.
So that's
They don't have to,
sometimes
yeah.
people do that for cash flow initially when they're
Yeah, exactly right.
and then once they're established, they might stop doing it.
Exactly right, yeah. But that's what forms the concessional contribution. Now, most of the other contributions you make to super is what's called non-concessional contributions. So again, during your working life, you're not in a position to be putting large amounts of money into superannuation. You've got your employer. If you want to put more in, your salary sacrifice, or if you're self-employed, you put that in. There is an annual limit that you can put in as a concessional contribution. At the moment, it's $30,000 per annum. So let's say your employer puts in 20K, that's the compulsory. You can then put in another $10,000 and then claim that amount as a tax deduction. So the other forms are, again, non-concessional, and that's what forms the tax-free component.
Yes.
So what happens is so once you get to retirement age, you look at your superannuation balance. Again, most of it will most likely be taxable.
Yeah.
Because people haven't been in a position to put large amounts in. If they have, they'll go up to that limit, get a tax benefit.
On that point as well, though, most people, because they're not getting it instantly, they're not really, some people don't, well, I've seen a lot of people won't consider because they think, oh, super, I don't care.
Correct.
That's later on.
Correct.
But it slowly creeps up and the next
Yeah. You're retiring,
I actually did do that earlier.
Yeah.
The compounding impacts
Yeah.
have been huge.
Exactly right.
And it's almost like an afterthought.
Yeah.
It's like the sooner you start, the better.
Yeah, exactly right. That's 100%. And, we can talk about that later on, about compounding and the compound interest. But so if you retire and most of your component is taxable, if you were to pass away and your beneficiary is your spouse or de facto spouse, or what's called a tax dependent, like dependent children, they're not adults yet and independent, they will receive that, either of the benefits tax-free. It doesn't make a difference. But if you're in a position where you're single, or your wife or your partner's passed away, you don't have any dependent children, they're all adults, and you want to leave your money to those, or to those people, that taxable component, which, like I said, usually makes up a large chunk of someone's super, they get taxed at usually up to 17%.
Okay.
Yeah, so
Substantial.
It can be quite substantial, obviously, depending on the benefit. So, you got $1 million in super once you retire, and that's predominantly taxable, and your spouse, you're single, or your spouse has passed and your kids are grown up, they could pay up to $170,000 in tax on that $1 million. So a strategy is approaching retirement, and what I did with these clients is, before you start a pension, so these clients were going to start a pension from their super because they needed the money to live off.
Yes.
They're not at pension age in terms of receiving the government age pension. They were younger than that, might not necessarily qualify for it due to their assets. So strategy there is they were going to convert their super into pension, which they came to speak to me about. What we did is we took a large amount out of super before they did that, and then recontributed in as a non-concessional contribution.
Yes.
So you are able to, and this is not a strategy that people should go and do on their own. There are a lot of rules and regulations.
And it's client specific, case specific.
Exactly right.
That's why it's individualized, and you need to seek proper advice.
Exactly right. There's rules about taking money out of super first of all. You and I can't take our money out of super because we're too young. The main condition... Sorry? What was that?
It's taking a piss is that I'm 60.
Oh, okay. You certainly don't look 60. But basically, you have to meet a condition of release to take money out of super. The main conditions of release are reaching age 60 and having retired, or reaching age 65.
Yeah.
At age 65, you can take your money out regardless of if you're working or not. So first of all, you need to make that. And then there's amounts, that contribution limits, like how much can you put back into super?
Yes.
If you have over a certain balance, you can't put money into super. So there's all those kind of rules. So again,
it's so intricate, and I loved it because I was fortunate enough to be party of at least the instruction, and then the clients have come back and said to me that they were really happy with what you've done for them. I could never have given that advice. It's not my position to give that advice, right? But it was just that instruction, basically purely based on the fact that they trusted in me, into putting me with somebody that they trust in, right? Yeah. What I've noticed over the years that I've known you, and I was working from the office at some stage as well, is I've watched the consistency of you and how you deal with each of the clients. all of this is you can't just get this advice from somebody that doesn't have that long-term experience.
Correct.
There's some junior advisors out there, they need to go through the ropes, right?
Yeah.
They need to understand the pros and cons. And you can be very educated, but without having those market cycles and decades of experience with numerous clients as well, you can't give that value.
Oh, 100%.
There's a difference between you and a 29-year-old that's just walked off the block, right? I'll be honest. I prefer, the reason why I've come to you myself is because I know how you've worked with other people, and I'm pretty anal. I know a little bit about financial, like financially literate. So for me, it's important that you can fill the gaps for me.
Yeah.
So I just think what you're doing is fantastic. What you've done for them was obviously they were blown away. So again, I love that. I've been able to take somebody that initially came, it's like, should have paid off my mortgage because it just got made redundant. And I was like, I think this is a bigger question.
Correct. Yeah.
Go and see this guy. And then they've come out with a truckload of value.
Yeah.
And they never would have been able to figure that out.
Well, in this case here, they, it might not, this strategy, they might not require it because at the moment it's the husband, his wife is still alive. If she's a beneficiary, she receives that super, she won't pay tax regardless. But if that's not the case, this strategy alone would save their adult children or his adult children up to almost $40,000 in tax.
Absolutely.
If it's a strategy that may end up, eventuating. And, in one fell swoop, you could save with this strategy up to $60,000 in tax. And over a longer period, you could save even more. And this is the thing with having a financial advisor, right? It's not, a lot of the times people come and then you implement a strategy, but if they had been clients for a longer period of time, you could have implemented a similar strategy or get that ball rolling earlier where the benefit would have been greater.
Yes.
If that makes sense.
Because majority of people, and this is what I find, look, I'm a little bit obsessed with finance. I have been since I was young, and that comes from the fact that I've watched my parents grow from a place where we didn't really have much when we began. My parents are very successful now, but they've worked really hard to get to where they are. Most people that aren't financially literate, I made sure that I was financially literate because I wanted to make sure that I could provide for my children and my family. And I think it's vital. Everybody should have some form of financial literacy.
Yeah.
If you don't, you'll never, for them, they've come in a bit too late. That's the truth. If they came to you 20 years ago, they would have been already planning towards this and might be in a
Exactly.
Yeah.
Yeah.
But it doesn't mean that they're not in a bad position.
That's right.
They actually are doing well, these particular clients. But there's a lot of clients that aren't. And sometimes people get fearful of coming to an advisor when they think that they don't have enough money or they're not in a strong position. But it's better to come to you sooner.
Yeah, exactly right.
But if you don't know these things, you need to engage in someone like yourself.
Just meet and have a chat, right? At the end of the day, no one's got to hold a gun to your head and say you have to implement these strategies. You see an advisor come in and you have a chat. You talk about what strategies, you present it. Ultimately, at the end of the day, it's their decision whether they want to proceed. And that's a big thing we're finding with industry funds. Yeah. So every second day almost there's an article, feels like it, in the Financial Review, Australian Financial Review, a review about industry funds. Now you go to an industry fund, the amount of money that industry funds manage at the moment is just astronomical. I think the super industry in total in Australia is about $4.5 trillion. I think the figure is. I might be incorrect.
I think I'm know where you're leading with this.
Yeah. So the only thing that they do for clients is just manage that portfolio, and it's up to you to determine where you invest. They're not going to talk to you about, okay, should you have more growth assets or defensive assets? Where are you in life? If you're younger, then you can be aggressive, older.
So not coming in with tailored advice.
Correct.
It's just it's a blanket portfolio for X person between this age and whatever age.
Yeah.
And they're not going to be proactive and saying, hey, actually, you're in balance right now. Maybe you need to be in high growth or whatever it might be.
They can't do that. Yeah.
So your role is to take them out of that. And it doesn't mean that you take them out of it.
Yeah.
Of a fund, but you might put them in a better place fund and then actually rejig and say, well, because of your age and your circumstance, you should be in this position right now.
Correct.
And you can review their insurances and everything else that's complementary.
Well, that's the thing, right? It's one of the main jobs is managing a portfolio and getting returns.
Yeah.
But that is really, in my opinion, people probably place too much emphasis on that. And again, that is a very important thing. You want to have good growth, but it's more strategy advice as well. So investing and having good returns is one thing, but having strategies in place. So at the moment, and there's a lot of talk about the amount of baby boomers approaching retirement that would have no idea what to do. Like these clients, right? They needed advice. They took the advice on. So many clients approaching retirement, or not clients, so many people approaching retirement have no idea. So now, the government's saying these industry funds
They need to
that
stop.
manage, $1 trillion, I think Australian Super might manage, they need to start taking a more hands-on approach and trying to provide that. But at the end of the day, I know if I'm approaching retirement, I don't want to ring a 1300 number up at Australian Super and get who knows to start giving me advice. So there's a lot of talk about these industry funds making all these fees. Then the CFMEU getting involved in CBUS and all the conflicts of interest there, and so you get a lot of people that are happy with their industry funds. It's cheap.
Yeah.
But what are they missing out on as a result of that?
It's a hard one because I've witnessed it where some of your clients, what's best for them, and you wish you could bestow on them all your knowledge, and they can't hear it.
Yeah.
Like you talk, it's white noise, and you're sat in front of them and you're like, you could plead and tell them and lead the horse to water, and they just don't. And you're like,
oh, it's frustrating. Don't get me wrong. But
it does happen.
Yeah.
And knowing what I know, it's really hard. Sometimes it happens with myself as well, and I think, if they just listen to me.
Yeah.
Especially with house prices and interest rates going up the app as well. And I think they just listened to me. They didn't sell back then. But at that time, they had to sell that property when it was only 200, but now it's worth 600.
Yeah.
But you've got foresight because of your tenure in that industry.
Yeah.
I do in my industry, you do in yours. And sometimes you just go, I just wish somebody could help them. But they feel, I don't know if it's because they feel burned because they've watched, and what you want. Sometimes they can think that you sell, it's a salesman pitch.
Yeah, they look at
you're not
potential fees and all that kind of stuff, and that might, but
I've been privy to watching you where you've gone and seen a client, and if there's nothing that you can actually do for them, you're like, well, I actually can't help you in a great position. So.
Yeah, exactly right. And you know what, we get a lot of those clients, which is great. But
most of the time you can always do better.
Oh yeah, absolutely. Yeah, exactly right.
So I guess so besides that though, what's the most obvious issues that you see with people? So what's it do clients come to you with?
Yeah, so the biggest issue that you see with people is the mismatch between their goals and objectives and what they're willing to do to achieve their goals and objectives, the sacrifices they need to make. So that would be the biggest pitfall, if that's the right word to use. And an example would be you meet with clients, they might want to retire at age 65, they might be 40, so it's still a while away, right? And you talk to them and you find out what they would need in what they think they need in retirement, right? So they'll come out with a figure, let's say it's $100,000 per annum in retirement. Hopefully they're mortgage free, kids are out of home, but still $100,000 in this day and age doesn't get you too far.
Well, I was going to say, so if somebody did actually want 100,000, right? How much would they need in super right now?
Well, right now, what I do is I multiply it by 20.
Yeah.
So 100,000, you would need $2 million in super anyway. So I use that theory is what you want a portfolio big enough where that income you need is derived by the income from the portfolio. So whether it be interest from some cash, dividends from shares, if you got some property, the rent.
Yeah.
So if you take a 5% yield, you want that 5% from the portfolio to...
It's super conservative, yeah.
Well, 5% is not the return figure. 5% is what a yield from a diversified portfolio. So let's say you got 2 million, 5% is 100 grand, and basically you're not eating into the capital by doing that, right? So, but then you've got that capital there to go on holiday if you need a lumpy cost, so you can dwindle the lump sum because you ultimately don't want to be getting to 95 and about to pass away and have 2 million in super. Well, you might want to leave it. You might want to do that to leave it to the kids, but that's not the purpose of superannuation or a big portfolio. It's to use it, but that's the strategy I use. So where you can that income you derive from that portfolio is enough to cover your annual living requirements, and then you've still got that balance there where you can utilize. So that's how I get to the 5% figure. So that is
about right. Like, so $1 million used to seem like it was a massive amount of money to have in your super. People generally have 1 million's a really good figure in mind. It's like once they've cracked that, for an ordinary person, like, I've made it. I've got $1 million sat in super.
Yeah.
Well, really, because of inflation and everything else, you're like, yeah, really?
Correct. So $1 million is a decent amount. So
as a couple combined, like 2 million's great.
Yeah, 100%. Exactly right. So statistics come out and they say the exact figures, but to live a comfortable lifestyle right now, if you're in retirement, a couple probably need about just over $70,000 a year.
Yes.
Now, remember, if you've got $70,000 you're getting from a superannuation portfolio, that's tax-free. So it's equivalent to earning maybe $100,000 and paying tax, right? So 70,000, most people is enough. If you got no mortgage, if you got no kids that are all moved out, 70 after tax is a good amount of money. So so when I talk about $2 million, I don't want people to start Freddie. And this is more about, if you needed $100,000, that's what you need. And remember the age pension as well, that can kick in. So again, a comfortable lifestyle. If you're retiring now, they say you probably need about $600,000 in assets, liquid assets, not your home. Obviously, you can't sell off a bit of your home to live off, but in liquid assets. So, but again, the mismatch is, people come in, okay, this is what you want, $100,000 in retirement, you need $2 million. Now, then we work out, okay, what have you got now in super? What are you likely to have accumulated in super in 25 years, including all your contributions? This is what you're going to get to. They may be $500,000 short. And then it's like, okay, well, how do we get there? How do we get there? And the way to get there is to start contributing more to a portfolio. Do you set up a portfolio outside of super? The benefit of that is if you need that money, you've got it. By putting money
within real estate,
it's more
But it's like people, but they're considering real estate over doing.
Oh yeah, so whether it's real estate or shares, like I don't. When clients come in, I have a preference for shares. That's what I know. But I never tell clients don't buy property. My mantra is whatever asset you buy has to be quality.
Yes.
And you have to be in it for the long term.
Yeah.
So
you're not short.
If a client comes in and goes, I've got $100,000 and I need that money in 12 months for a deposit on the home, should I invest in the stock market? Definitely not.
Because it's high risk, right?
It's high risk. Anything can happen in that period of time. So I don't
want to bear that. I've taken somebody to put 100,000 in and something catastrophic happens that nobody's got control over, such as COVID.
Yeah.
Next minute they've lost 40%.
Correct.
And they can't even get into the housing market. It's like, so people need to understand your job is to, you are in a risky business with shares, but ultimately you're de-risking people because you're evaluating their position, what's unique to them, and their life stages and everything else. It's so much more complex than people think.
Absolutely.
And that's what hits onto the influencers. So the financial influencers now, which are, this is the whole point of why I'm doing this, because you know what you're doing, you're experienced. I am overseeing this jargon and people talking, and some of them are out there, they're not even qualified. They don't have bare basics. They don't even have a cert for.
Yeah.
And they're talking about financial advice.
Yeah.
And it's without context.
Yeah.
It's just a short snippet, hook somebody in, and then next minute they're buying something that they absolutely should not be buying into.
Yeah.
And my concern is that there's so much misinformation out there. My role is to hopefully help people understand that it is boring. Most of the time, it's a slow growth situation.
Yeah, it is, yeah.
It's not a quick win. It's been this crazy ride the last 4 years where everybody's won in the real estate game and also probably in stocks because it crashed 30%. It was in March 2020. I know that's a fact. You can look it up on ASX. It crashed 30%. So if you bought in then, you've probably made 40%, right? But again, an anomaly. It's not, there is no such thing. If it's a quick win, then it's obviously going to be, there's something wrong with it.
Yeah, yeah.
We know it's a long burn.
Absolutely. Unless you get the timing absolutely right. Like you said, you happen to, fall into an inheritance and you get that money as soon as the market crashed and you invest it at the COVID
you can't
lows.
Say that you've done that on purpose and you knew.
Yeah, people will claim it, of course. There's a lot of them around, but you can get lucky.
Yeah,
that is lucky. It's time in the market rather than timing the market. That's the old saying.
It comes across, and that's in real estate also.
Absolutely,
It's across shares and
every asset,
commodities, right? And I think people need to understand that it's not going to be sexy advice. You're not going to make 100% immediately or 50% even. It's going to be, you're going to have to work. If the only controllables you have is your income, right?
Yeah.
So if you do want to have more net income, you're going to have to upskill yourself. Go do FIFO, for example, because I do work with a lot of FIFO clients. And then you've got more disposable net income, then you can start investing in shares, investing in real estate. But again, for the long burn.
Well, you can try and double your money in a quick, but there's going to be high risk involved in that. That's for sure. So
That's what you're willing to bloody.
Well, you might lose 99% of it in quick time. But yeah, it's a long-term strategy.
So ultimately, I guess. So look, we've discussed quite a bit. I had some questions here that I want to ask you, but I think that we've covered quite a lot. What I guess if we want to round it off, why is it so important that people do come and see you sooner than later?
Well, again, it's a lot of the time it's a long-term strategy, right? It's meeting your financial goals and objectives. Very rarely can you do it overnight. So it is a long-term strategy, and the landscape is always changing as well, right? So, you mentioned before, the thing you like about myself is my time in the industry, but it's also keeping on top of all the changes, right? So I read this morning, or the last couple of days, about there's so much money that you can put from super into pension when you retire, and because once you retire and you have all this superannuation, I don't want to bang on about superannuation, but it is one of the best investments.
Yeah.
So the thing about superannuation is it's when you retire, you don't pay any tax on the gains or any income generated. Yeah, absolutely.
It's such a good way to grow wealth. But it can be a part of the whole.
Correct. And you can do outside, inside.
Looked after that, and then all of a sudden you go, well, actually, I'm trajecting nicely here, and then you still got some net. You can do things outside of, right? It's
exactly right.
Balance.
Yeah. So there's $1.9 million each person can put from super into pension to convert it and then start drawing a pension from that. Above that, any income or gains is taxed at 15%. So that is now going up to $2 million as of, I think, is next financial year. So that's the amount you can put in. So if a client came to me right now and said, I'm retiring, I want to put my money from my accumulation into super, and they had more than that $1.9 million. So obviously if you got under, it doesn't matter.
Yes.
But if you had more, a conversation I'll be having with a client now is, do we wait until July when you can put that extra $100,000 into that pension fund and not pay tax on that $100,000? So that's, why you having a financial advisor, for all those reasons, that things are constantly changing. And that's why some people are negative about superannuation. The rules are always changing. It's always going to be the best environment to accumulate wealth. But even outside, it's, again, setting up strategy as early as possible, because, it's never too soon. It's never too late, but it's never too soon to start, putting a strategy in place. Correct. Little things like, you have a couple, one's a high income earner, the other one might be earning less, maybe, $30,000 per annum working part-time. Little things like the government co-contribution. So if you earn below a certain amount, you put $1,000 into superannuation, the government will give you $500 into your super. It's a 50% return. Little things like that where people they wouldn't know. And there's so many strategies like that.
So there's so much value in getting advice.
Absolutely. So, and again, it's never starting too early.
Well, thank you so much. I reckon we've covered a lot just in our first podcast. I definitely want to have you back. And we can cover so much. I can talk about this stuff all day.
Yeah, there's so much to cover.
Like that.
Yeah.
Once we get rolling, it's just easy to slip into it. But I just think that we've got to now start turning the tables where there's so much false advice out there. I want to bring you to the forefront because you do know what you're talking about. And at one stage, we might even do it where we can get the clients to come and ask questions and we can fling them to you. Ultimately, this isn't advice, it's general advice.
Absolutely, this is all general advice,
Ultimately, everybody's situation is so unique, so they need to get tailored advice. This isn't going to fit everybody. It's just snippets of showing you what you can be missing all the time.
Yeah, exactly right.
Thanks so much.
Well, thanks for having me, Janine. It's been an honour.
Yes.
All right, thank you.